Welcome back to another episode of What's on Your Mind. I'm Chris Quill, and today I'm delighted to have Anthony Iser and Jason McDonald joining me on the call. As always, we're going to have the benefit of listening to these guys' insight about financial markets and also equity ideas that they're looking at for their own portfolios. Gents, great to have you on the show again. Let's just get stuck in. And Jason, why don't you take things away today?
Hi guys, hi everybody. Good to see you again. So straight into my long idea. Basically, I've been playing the oil price on a fairly tight range. Where we currently are, we kind of WTI and Brent crude. I don't really have a strong opinion either way. I'm kind of leaning to the long side, but as I said, I've been trading it in a relatively tight range. And this kind of feeds into that theme. So the idea is long a company called Phillips 66, quite a large company, ticker PSX, market cap 51 billion, and they closed around 107 bucks yesterday. So what do they do? Fairly easy company to understand. It's basically a refiner, and they've also got some midstream and specialty chemicals operations. So a little bit of history in terms of the corporate background. Basically, this company was formed from a 2012 spin-off out of ConocoPhillips, and it was their downstream businesses that got consolidated into a separate independent publicly traded company. So they are, they process, they refine, they transport, store and sell fuels and kind of related products all over the world. They've got four business segments: midstream, chemicals, refining, and what they call marketing and specialties. So the midstream business last year contributed about 14% of their earnings. So that was just under 1.8 billion. And that business essentially gathers and processes, transports and sells natural gas and natural gas liquids. So this thing called NGLs, mainly in the US. They also transport crude oil and other commodities to their own refineries and other locations in that particular part of the business. Then you've got the chemicals business, which is the smallest part. That was about 6% of profits last year, so 856 million bucks. And, as the name suggests, they're manufacturing and selling petrochemicals and plastics on a global basis. That business is actually a joint venture with Chevron. So they've got a 50-50 stake in that JV, and it's called the Chevron Phillips Chemical Company, mainly concentrated on the Gulf Coast in the US and in the Middle East. You've then got the refining business, which is the kind of lion's share of the business. So 61% of earnings last year, just under $8 billion worth, which is a buying, selling, and refining crude oil and other commodities business. They've got 13 refineries across the US and Europe. And then the last part, the fourth segment, is what they call marketing and specialties, which is about 18.5% of earnings last year, 2.4 billion. And in that business, they're buying and marketing for resale refined products across the US and Europe. And that's also got their manufacturing and marketing of specialty products in there. So the quants, now this is a bit of an unusual one, which I'll come on to. It's not a usual profile. And as I say, I'll come on to that. So EPS for last year, 2022, was $18.79. We're looking at consensus of $14.87 for this year, which is clearly a drop. And then EPS consensus for next year, 2024, of $12.51. So another drop. So basically, you're looking at earnings growth for the company, negative 20% for this year and negative 16% for next year. They're on a PE of 7 times for this year, 2023, and 8.6 times next year, 2024. They've got a dividend yield of just under 4%. Short interest, pretty negligible at 2% and 3 days to cover. Now, the sector comps, they look good on the sector comps. So the rest of the sector is on average exhibiting an earnings drop of 32% for this year and 36% next year. And basically, they're on a similar PE to the sector. So the sector's on 7.5 times for this year and about 9 times next year. So, as I said, earnings expected to fall this year. And that's basically because of crack spreads narrowing and gasoline and chemical prices falling, which is obviously something that we're all familiar with. There's obviously a big basis effect from last year. Now, the reason I like this company is because I'm looking at it from an operating cash flow perspective, and they've actually got a free cash flow yield to equity of around 17%, which is exceptional. And it's an extremely shareholder-friendly company. So, for example, they paid down $2.5 billion of debt last year. As I mentioned, they're already paying out a decent dividend of 4%, and they are increasing that all the time. They've got a big share buyback program in place. They've just announced an increase to that buyback program of $5 billion. Now, think of this, you've got a market cap of $51 billion. And essentially, they are on track to return by the end of next year $12 billion in total shareholder distribution. So, as I said, we've got an excellent free cash flow yield here and a very shareholder friendly company. And lastly, after the recent results, which I'll come on to, one of the directors has just put his money where his mouth is and bought just over $1 million worth of stock, just below 100 at $98. And that director is actually a CEO, but he's not the CEO of Phillips. He's actually the CEO of Raytheon. And he's currently not buying shares in his own company, but he is buying shares in Phillips 66, having joined the board last July. And this is his first open market purchase, which, that's an interesting statement, I think. So last earnings report, which was at the end of January, their Q4, they missed on EPS by just shy of 8%. So they came in with $4 as opposed to consensus expectations of $4.34. They had a big beat on revenue of 19%. So revenue came in at just under 41 billion compared to an expected 34.3 billion. Stock price is basically flat since that report. And we've got next earnings expected in early May. The trade structure, I'm long stock. There's nothing on offer that's particularly exciting on the option side of things. Now, the stock has actually, annoyingly for what's on your mind, it's rallied a bit in the last week. So I got into this last week just below 100, and we've had a bit of a rally in the oil price and generally across the board since then. So my take on this would be, you want to get in as close to $100 as possible. I'm not looking at an outrageous price target over the next 3 months. I'm just looking for 15-20% out of it, and as I say, I'm long stock.
Cool, good stuff. Anthony, let's go over to you. What have you got?
Hello, Chris. Hello, Jason. Hello, everyone. Hope the new year has started well. It certainly has down here in Australia. It's 38, 39 degrees the next few days. Summer still in full swing. I've got a short idea. And if you have a look at this first chart, it sort of sets the scene for what I'm thinking here. This is a national housing survey. Basically, is it a good or bad time to buy a home in the US? It's down dramatically, as you can see. More than 70% of people saying it is not a good time. It is a bad time to be buying a home. And the second chart that coming up here, US pending home sales, is showing that they are following through on that. Sales down 30%, albeit with a slight tick up from the number in November. And then finally, another chart looking at the price of homes, new home sales broken up by prices. And you can see here over the last 2 decades, the lower end of town, the bottom 2 lines under 300,000 with the red, and the sort of darker orange, 300 to 400,000, has been declining. And you would expect that. Inflation has seen house prices move up over time, and this segment here getting smaller. But it is also a function in more recent times that this is a component of the market that is getting dramatically affected by the increase in interest rates. And across the whole market, this one final chart to sort of set the scene, looking at months of supply of new housing, shows that we're up around 9.5 months. Again, the last month or so just ticking down a fraction from almost 11 months. This is a lot of supply that needs to get cleared. And that sets the scene for a short idea that I'm looking at, which is LGI Homes. Ticker is LGIH. The stock's trading around 117 at the moment. Results are coming out next week, Tuesday, before the market. It's put on a fair bit of price performance in the last month. Year to date, it's up 26%. It's up about 60% from its low in October. And this is all the while earnings continue to get ratcheted down. So this has been driven by multiple expansion, and I'm thinking there's going to be a disappointment coming forward. Ideally, it'll be coming through in this result now, but when we get to the trade structure, I'll talk about why I've sort of pushed that a little further out, just in case we've got another period here where things do come through a little bit better than expected, although that's not my base case. And there's a few people clearly thinking the same thing as me. This is one of the more heavily shorted stocks in the sector. It's 12.6% short interest as we speak. When it comes to earnings and where they sit in the market, clearly selling houses, building them. One of the key differences between this and its peer group is LG Homes builds houses on spec. So they don't have buyers, they build the homes and then go and find the buyers. This is, it's a more aggressive strategy and particularly beneficial when there's a huge amount of demand. You just build them as quickly as you can, and there's a buyer waiting there. It also helps you take advantage of price rises because you can then structure your pricing around your cost. One of the issues many home builders have had is they would have contracted prices, then they saw the cost go up dramatically and their margins getting squeezed. So that's not an issue for these guys. But what is an issue is that top line declining in the year that's just about to be finished, 2022, looking for sales to be down 23% for the full year, earnings to be down 20%, and then that flowing through pretty aggressively into 2023 as well. Sales down just the 3% is what the market's forecasting. And I do think there's risk to the downside on that, and that's, I think, what's going to drive the share price lower. But that 3% decline in sales is leading to a 35% decline in EPS as margins get squeezed. So the quarterly number that's coming out next week, along with the full year number, they're looking for sales of 530 million. That's down from 800 million in the fourth quarter of 2021 and down from 547 in the third quarter, so sequentially. And again, on the earnings side, $1.68, well down on peak earnings of 453 in the fourth quarter of last year. And again, well down on the big number that they had in the third quarter, which was $3.85. So from that October low, we've seen the share price go from $76 up to about 117 now, all on multiple expansion. The PE is expanded from the low point of 3.9 to 14 times. At the same time, the next 12 months earnings has fallen from 20 to 8.9. That's June through to now. So earnings have almost halved, multiples expanded rapidly, and we've seen the share price going up. In order to justify that, we need to have the market looking through these trough earnings and seeing a big rebound out the other side. And I don't think that's going to happen. Key KPIs, and again, highlighting to the turnaround in performance here. Number of homes on a quarterly basis for the third quarter over the last few years from pre-COVID levels was 1,600 homes in 2018 to 2000 to 91 in 2020, 2500 in 2021, but dropping back down to 1500 in the third quarter of last year. And the saving grace for them, though, was the increase in price. And that's where we saw, seeing margins going up. So a record pricing level of 353, which is very much at the low end of the US housing market, despite the fact that it's rallied very strongly from that 2018 level. So 2018, it's gone from 237, 241, 253, 300, and up, a very, very punchy 18% in the last quarter. Now, it needed that because we saw home closings down 38%, and the combination leading to a decline in revenue of 27% from the previous year as well. So how did they disappoint from here? The key factor really is that, what is sales? What is revenue? It's price times volume. We've already seen the volumes been ticking down aggressively, down 34%. Again, in January, they've released their January sales numbers. They only sold 331 homes, so they're down 34%. I think there's really quite a bit of risk to pricing, which tends to follow through after volume. Companies start to face increased competition. Competitors will cut prices, and then LGI Homes will go and follow through with that as well. So I don't expect them to see that 353,000 average. I think it's going to be quite a bit lower. And once that starts to flow through, we'll see the outlook getting cut and people wondering why they were thinking that paying 14 times PE for a company that's under this much pressure was a good idea. So with stubborn inflation, we've got 30-year mortgage rates as well, still stuck above 6%. We're likely to see at least a couple more rate rises. So that number's not going down anytime, and that would need to come down to see volume start picking up. It's becoming very hard to look through that earnings trough and out the other side to a point where we can see volumes and pricing growing again. And I suspect that this result coming up might be the thing that makes that abundantly clear to the market. Now, as for price target and trade structure, I'm looking at $95, which is simply unwinding the year-to-date gains that the company has seen, still well above the October lows of 75, 76. And an aggressive view with the result being next week would be to put on a bear put spread where we buy the March $115 puts. That's going to cost me about $5.45. I could sell the 95s for about $1.45. So a total unit cost of $4. My break even is going to be 111 versus the 117 share price, and a payoff at 95 is 4-1. So I'm sort of quite pleased by that. But it doesn't give me a great deal of time should this result, somehow that they sort of grind through with slightly better volume, but more likely perhaps slightly better price. Again, it's not the base case I see, but I've decided I'm going out a little further. So going out to May, I can do the same bear put spread in terms of buying at 115 for May, but selling 85. So I've got a little bit more room on the downside that I need to make up, but I've got 3 months further to do that. That's a spread that's going to cost me about $6. So break even of break even of 109. I still get a 4-1 payout ratio if it reaches that bottom end, and I've got 3 months extra to see that play out. So that's what's on my mind. I think this is a sector that's going to increasingly have to face up to the reality that the market just cannot absorb the volume that's out there while we've got interest rates continuing to tick up.
Awesome. Thanks for that one, Anthony. Yeah, I think I agree with that last sentiment as well. We're seeing it over here for sure. Jason, let's go back to you. Have you got anything else you wanted to talk about?
Yeah, I've got a short idea in a company called United Rentals, ticker's URI, market cap 31 billion. Closed the share price closed around 456, so $456 and a half yesterday. So what do these guys do? They are actually the largest equipment rental company in the world. They've got 1,500 plus rental locations across North America and Europe, so that's the US and Canada. Who's the customer base? Basically, construction and industrial companies, utilities, municipalities, government agencies, independent contractors, and in fact also homeowners that use their equipment for projects ranging from simple kind of repairs to major renovations. The main products and services are equipment rental, selling the rental equipment, and contractor supplies. So they've divided their business up into two business segments, general rentals and what they call specialty. So general rentals is 74% of revenues last year, and that's rental of construction, aerial and industrial equipment, general tools, light equipment, and kind of related services to those products. They include in that renting out general construction and industrial equipment, aerial work platforms, and general tools and light equipment. And they've kind of subdivided that big segment into 4 geographical regions. So this is in North America, so Central, Northeast, Southeast, and West, operating through Canada and the US. And then the smaller segment is specialty, which is 26% of revenues last year. And that's renting out specialty construction products and related services, like trench safety equipment, power, and HVAC, which is heating, ventilation, and aircon equipment, and fluid solutions equipment. So the quants, you're looking at for 2022 EPS of 32.50, and for this year EPS consensus is $40.93, and next year is $44.04. So that gives them, according to the analysts, earnings growth of 26% this year and 8% next year. They're on a PE of 11.1 times for this year and 10.5 times for next year. Dividend yield, pretty paltry, 1.3%. Short interest is just over 5% and just over 5 days to cover. So the analysts have them, outperforming in terms of earnings growth. So for this year, the sector's on 11% earnings growth, which is less than half what the analysts believe United Rentals will generate. And for next year, the sector is actually growing at double the rate that these guys are predicted to grow at, so 15% as opposed to 7.5% for United Rentals. And the company is actually on a fairly decent discount on a PE basis to the sector. So the company is on 11.1 times versus 18 times for the sector for this year. And the company is on 10.4 times next year versus 15.4 times for the sector for next year. Now, the short idea here is this is what I kind of call an is it as good as it gets type short. So there's an element of contrarianism here. So there's a spoiler alert for you. Now these guys have got really, really fat gross margins of 42%, which basically were swelled by the 2021-22 COVID-related bounce, the bounce back, and all the supply chain issues that we're all familiar with from that particular time. And part of the reason why the share price has performed really well also is that they are going to get some big tailwinds from 3 federal government bills which were recently passed in the last couple of years. So those bills being the Infrastructure Investment and Jobs Act 2021, which is basically $500 billion worth of infrastructure spending from the federal government over the next 5 years. The second thing is the CHIPS Act from last year, which is the full name, bit of a mouthful, creating helpful incentives to produce semiconductors and science is what the CHIPS Act stands for. That's an incentive program that's just shy of $300 billion over the next 10 years. And then you've got the last one where they are expecting to get a tailwind from is the IRA Act, the Inflation Reduction Act from last year, which is another $400 billion worth of incentives. So basically, the management and most of the analysts are arguing that those 3 things are going to reduce the cyclicality of United Rentals business. Now, my contention is that, yeah, fair enough, but because of the complexities and the delays and the difficulty of getting the funding mechanisms in place at the state and municipality levels, I think that these stimulus bills are actually much more a 2024-25 event for these guys rather than a 2023 event. So why, how have these guys got to what I'm kind of arguing is it doesn't really get any better than this for them type situation, is that as a result of all the bottlenecks, post-COVID that we're all, well and truly versed in, that, because of those bottlenecks, they essentially experience the best possible environment that they're going to get in a generation. So those bottlenecks, they've now essentially disappeared. There's much more equipment available, which means that their fleet utilization numbers are going to go down. And I think that that's also going to lead to pricing pressure for them. So that's number one. Number two, the knock-on effect of that is that these guys sell used machinery, and I think that used machinery prices are also going to drop as a result. And to put that, how good that business has been for them in the last couple of years into context, last year the gross margins on their used equipment sales were a full 19% above the average margins that they were experiencing in that business in the 3 years ending 2019. So basically what I'm saying here is that, far from kind of extrapolating these high margins indefinitely into the future, that there's actually going to be some mean reversion, especially if industrial customers start feeling the heat later on this year. And, so heaven forbid that we have a recession, which, we'll talk about briefly later on actually, but even if they don't experience a recession in the US, I think that, demand on the industrial side for renting the equipment from these guys is certainly going to be under pressure as we get further into this year. And then on the subject of those industrial customers, even without a cyclical downturn, I think that they're going to be experiencing lower demand because these guys can now buy their equipment rather than renting it, which is not the situation that they faced back in 21, 22. Now, the stock's massively outperformed the S&P since the end of 2019 on a total return basis. These guys are up 174% versus 35% for the S&P 500. Essentially what I'm saying here is that the equipment rental business has had a fantastic cycle, and that even without a recession, is that party over? So I think that in summary, the government stimulus is actually next year's story for them. I think they're going to experience falling used equipment prices and lower fleet utilization. I think they're going to experience lower demand from industrial customers, even without a recession. and I think there's going to be some degree of mean reversion after a fantastic cycle for them. And I think it's worth asking the question. So last earnings report was Q4 at the end of Jan. Small miss on the earnings side by 4%. So they came in with $9.74 versus expected EPS of $10.12. Revenue was in line at $3.3 billion. Stock price has rallied 17% since that report. And next earnings are due end of April. The trade structure, because this is a, as I said at the beginning, it's a contrarian trade here. Rather than being short stock, what I've done is just gone long some puts. Now, I've not put a spread on because I wasn't getting enough on the credit side. So I've gone fairly long dated and basically just gone long the June 16th $440 puts. Now those are at the moment they're costing around $30. So your break even on this is around 410. So that's about 10% out of the money compared to where the share price is at the moment. And I'm just long those puts. And I don't know, when the trade's going to come right, which is why I've gone quite long dated. And as I say, there's an element of contrarianism here, which is why I've gone for the puts rather than shorting the stock.
Cool. You mentioned that you might talk about some macro stuff earlier through that presentation, Jason. Was there anything you wanted to expand on?
Yeah. I mean, this kind of fits in with what Anthony was talking about with his idea, and also what I've alluded to here with these guys as well. I think the macro situation with respect to the US is looking a little bit confusing, let's say, at the moment. So we all know that the labour figures and payroll numbers, etc., and unemployment is a lagging indicator, and to an extent, it's backward looking. However, we've seen some fairly eye-raising payroll numbers recently. So the January non-farm payrolls came in at 517,000, which was triple the consensus estimate. And this kind of triggered an interesting comment from Powell when he was speaking at the Economic Club of Washington last week, and he said that the reality is that if we continue to get strong labour market reports or higher inflation reports, it might be the case that we have to raise rates more than previously anticipated. Now, of course, this is what is now being called the higher for longer, or the H4L narrative. And as a result of those comments, the 2-year note, which is particularly kind of policy sensitive, now is yielding at 4.5% compared to 4.1% before that Labour report. And that's okay. It's only one data point, and the jobs market, but whatever we say, the jobs market is still definitely very hot. Unemployment has dropped to 3.4%, which is the lowest reading since 1969. The labour force participation rate is 62.4%, which is the strongest since COVID hit, and within a percentage point of the January 2020 level. And this was amazing. I saw this number, that the number of unemployed per available job is at 0.5, which is basically the lowest reading on record going back to 2007, and is well below the 0.8 baseline in the months leading up to the pandemic. So what that means is, according to the US Chamber of Commerce, is that if every unemployed person in the country found a job, we would still have 4 million open jobs. So whichever way you cut it, the labour market is still extremely hot. However, on the contrary side here, in a Gallup poll which was conducted only last month, 50%, so half of respondents, said that they're worse off financially compared to a year ago. That's the highest percentage response since at least 1980, outside of the 2008 Great Recession. and compares to just 20% reporting a year-on-year reduction in their financial situation in early 2020. And it's not just at the low end of the pay scale demographic where people are experiencing, shall we say, financial pressures. So there was a survey conducted in December by payments.com and the Lending Club Corporation that found that just over 50% of respondents with annual earnings in excess of 100 grand were basically reporting living paycheck to paycheck, compared to 41% at the end of 2021. And Vanguard, which has 5 million Americans under their 401k umbrella, reports that 2.8% of those customers took out what they call a hardship withdrawal last year. And that incurs a 10% penalty fee when you do that. Now that's up 50% from pre the pandemic. So, when you look at these types of statistics and surveys and stuff, you're seeing a very different picture. And lastly, on the personal consumption expenditure front, which includes spending on goods and services and is basically, 2/3 of total economic output, that's declined sequentially in nominal terms in November and December. And apart from during the lockdowns in 2020, that's the first back-to-back monthly decline in over a decade. So what am I saying here? I'm saying that we're getting some pretty conflicting macro data. Of course, the jobs market is backwards looking and lagging. And, some of this information is really kind of a bit of a head scratcher when you look at what the market's done this year, in terms of, there seems to be an increasing kind of emphasis on a soft landing stroke higher for longer. Well, you're only going to get higher for longer if the economy is really strong. And I think there's a bit of an interesting dichotomy here that's developing between what bond markets are saying and what the equity market seems to be saying.
Yeah, certainly some mixed messages there. Anthony, what do you think about that? Does that add up with your macro view?
Yes, it does. And, adding to Jason's points about sort of how confusing it is, one of the things that's added to that confusion is the strength of the equity market in the last couple of months as well, because it seems to be discounting the chance of a recession. And we saw, increasing talk about a soft landing. I've got a couple of thoughts on this, and we're very much not in the market of making forecasts, but we do obviously pay a very close eye to what's going on in the macro world and can develop a bias to one side or the other. And I would highlight that the Fed has never been able to bring inflation down from the levels that it's been at without causing a recession in the history of the Fed. So maybe this time it's different, but I'm not exactly sure how. I've got a chart here just looking at Fed tightening, and Fed tightenings have always led to a recession when we've had these food and energy spikes in inflation. You can see on this chart, there's been 4 times since 1960 where the Fed has raised rates, and it didn't lead to a recession, but that was in the absence of a big spike in food and energy inflation. And for the younger people out there who haven't experienced inflation or don't have a good grip on why it's such an issue, if you look at frontier markets and emerging markets, when food and energy and housing inflation spirals, there are riots on the streets, governments get overthrown, and you'll see people dancing in the presidential palace and swinging from the chandelier as they violently overthrow the government. In the developed world, that doesn't happen, but governments are going to get voted out. So there's an incentive all around. There's also increased economic hardship with inflation. So I'm not underestimating the Fed's resolve on this. They would much rather make the mistake of tightening too much than too little. And I think that does lead to a recession. And I've yet to see the evidence that shows that it won't. That said, I could be wrong. And if it is the case that there's still a recession to come, then it's probably the case that we haven't seen the market lows yet either. And this second table here from Bank of America highlights their signposts, their lists that they need to see for a market low. And there's only 40% of them are ticked at the moment. And a couple of them, including the rule of 20 and the Fed cutting rates in the prior 12 months, haven't happened at all during this cycle. So I think there's still significant risk that we'll see market lows from here. But again, I could be wrong. We'll still have long ideas trying to find the quality names in amongst it. Another point to adding to Jason's ideas and thoughts on financial hardship for the consumer, bankruptcies has seen the largest start to the year since 2010 as well, as this chart shows. So people are feeling the pinch. Businesses are starting to feel the pinch. This is companies with more than $50 million in liabilities. But consumer confidence starting to pick up off the lows. So substantially off the 2020 lows, but still well down on what they've been historically. And I guess I'd just finish by reiterating that point that we're seeing all this talk about a soft landing, and that happens at this point in time because we're seeing the potential end to rate rises. Maybe there's 1, 2, 3, 4. We're not sure how many more, but we know we're pretty close to the end. And the economy is holding in there, and employment's holding in there. But that is very much the lagging indicator. We'll only know we've had a recession after it's finished. Now, the market will bottom out before that. We'll be riding upwards as we go through that recession. But it's easy to fall into that view of, okay, we will have a soft landing and it's different this time. And so I just want to finish with one chart here one headline from International Herald Tribune, which is a now defunct newspaper. It was quite good to read while you're on summer holidays on the beach. And this was from February 2007. Fed chairman predicts soft landing for US economy. Everyone always predicts a soft landing, and they think it can be different this time. And I'm yet to see the evidence how that's going to be the case.
Excellent, gents. Well,
and he's been around for 100 years. So he's seen a lot.
Well, gents, we'll wrap it up there. It's been a great episode. Thank you for coming on the show and sharing your thoughts on markets and also those ideas that you're looking at for your own portfolios. For those of you watching, I hope you enjoyed that one. Remember to check out our website, itpm.com, if you want to find out more about the events we've got coming up or our other educational offerings. And if you're ITPM alumni, then do get in touch with us if you're interested in joining the ITPM alumni Discord server, which we'll be launching free trials for over the next couple of months. So do check that out. It'll be really good for you guys. It kind of bridges the gap between what you're learning on the educational side with us and implementing it in practice. We're just trying to push you guys forward basically and get you more competent. So do get in touch if you're interested in that. But that is it for today. I hope you guys enjoyed it, and we'll see you next time for another episode of What's on Your Mind.